It is currently Saturday, November 29, 2025. The U.S. markets are closed. We are looking at the closing data from the last trading session, which ended Friday, November 28. Beyond Meat, Inc., ticker symbol BYND, closed the session, trading at exactly $0.98 per share. This represents a decline of $0.038, or a drop of 3.75% for the day. While the after-hours market shows a slight further dip to roughly $0.97, the primary story here is the closing figure, sitting visibly below the crucial $1 mark. The stock opened higher at $1.02, which technically gave bulls a glimmer of hope that it could hold the line. Seeing it push to $1.07 early in the session might have lured in some retail traders thinking this was the bottom. But the rejection at $1.07 was sharp and decisive. It didn't just drift down, it was sold off methodically throughout the afternoon, cracking the psychological $1 barrier to hit $0.96. Volume was heavy and the selling pressure was consistent. This indicates that institutional holders or larger players were using that morning liquidity to exit positions, not to build them. When a stock struggles to hold $1, it triggers a specific set of algorithmic trading behaviors. Many institutional charters strictly forbid holding stocks priced under $5, and almost all have strict rules against holding penny stocks under $1. As BYND crosses this threshold, forced liquidation from these funds creates a self-fulfilling downward spiral that has nothing to do with how many burgers they sold last quarter and everything to do with fund mandates. We have to address the short-selling dynamics immediately because this is one of the most heavily shorted stocks relative to its float in the entire sector. If you are holding this or watching it, you need to be hyper-aware of what the short sellers are seeing. Short interest in Beyond Meat has remained elevated for months, often hovering above 30 to 40% of the float, depending on the data source you reference. The expectation from retail investors in online forums is often that a high short interest guarantees a short squeeze, a violent upside move where short sellers are forced to cover. The reality is that short sellers are piling in because the company's balance sheet is deteriorating and they see a path to lower prices or significant dilution. Right now, you should be looking at the borrow fee, or the cost to borrow shares. When this rate spikes, it means shares are becoming hard to find, which can sometimes precede a squeeze. However, in Beyond Meat's case, the short thesis is being fueled by fundamental distress, specifically the recent legal news and cash burn issues. The shorts are betting that the company will have to raise capital, which dilutes existing shareholders, effectively lowering the stock price further. If you are trading this, do not just blindly buy hoping for a squeeze. You need to check the days to cover ratio. If volume is high like it was in this session, the days to cover drops, allowing shorts to exit their positions easily without spiking the price. A squeeze usually happens when volume dries up and shorts are trapped. Right now, the high volume on the sell-off suggests the shorts are in control, not trapped. Actionable advice here: monitor the fail-to-deliver data that comes out bi-monthly. A spike in FTDs at this price level could indicate that market makers are having trouble locating shares, which is one of the few technical signals that favors the temporary bounce. But be careful. Betting on a squeeze in a stock making new lows is high-risk poker. Let's shift gears to the business fundamentals, because the disconnect between the company's mission and its financial performance is widening. Beyond Meat was the darling of the 2019 IPO market, based on the promise of shifting global consumption habits. The expectation was that plant-based meat would reach price parity with animal protein and that health-conscious consumers would make the switch permanent. The reality has been a convergence of two massive headwinds: inflation and a shift in health perception. Inflation has been the silent killer. When grocery bills rose, consumers stopped paying a premium for mock meat and went back to cheaper animal proteins or basic staples like beans and lentils. Beyond Meat products are premium priced, and in a high interest rate environment where the average consumer is squeezed, premium alternatives are the first items cut from the shopping list. Furthermore, the health halo that protected the brand has slipped. There has been a concerted pushback regarding the processed nature of these products, with ingredient lists that some consumers find complicated. While the company has reformulated products to be healthier, like the new Beyond IV platform using avocado oil, winning back lost customers is infinitely harder than acquiring new ones. The data shows revenue declines in key markets, and the partnership with major fast food chains hasn't yielded the permanent menu dominance that investors priced in 3 years ago. The McPlant, for instance, did not become the nationwide staple many hoped for in the U.S. market, and that loss of a massive potential revenue stream forced the market to reevaluate the total addressable market for this company. We also need to talk about the elephant in the room regarding the recent stock movements, the threat of a reverse stock split. When a company trades on the Nasdaq and closes below $1 for 30 consecutive business days, it receives a deficiency notice. They then have 180 days to regain compliance. Beyond Meat is now dancing on that razor's edge. Investors know that if the price stays here, the company will eventually have to execute a reverse split, consolidating shares, for example, 1 for 10, to artificially boost the share price back up. While this solves the compliance issue, history shows that stocks often sell off aggressively after a reverse split because it's viewed as a sign of weakness. The recent shareholder approval for increasing authorized shares and potential reverse split maneuvers is a signal that management is preparing for all contingencies. This expectation of dilution or structural changes keeps new money on the sidelines. Why buy now at 0.98 if you fear a reverse split could shake out more value later? Macroeconomically, the environment is hostile to unprofitable growth stocks. Interest rates, while potentially stabilizing, are still high compared to the zero interest rate environment where Beyond Meat thrived. High interest hurt companies that need to borrow money to fund operations. Beyond Meat has a significant debt load, and servicing that debt or refinancing it becomes incredibly expensive when your stock price, and therefore your equity collateral, has decimated. The convertible notes that fueled their expansion are now a heavy anchor. If the stock price is far below the conversion price of those notes, the debt holders are not going to convert to equity. They will want their cash back. This creates a maturity wall risk that investors are pricing in right now. Comment below with your thoughts on the plant-based sector. Do you think the shift away from meat is just paused, or was the 2019 hype a complete bubble that will never return? I want to hear if you were seeing these products move off the shelves in your local grocery stores. Let's look at the institutional landscape. A few years ago, ESG funds were mandatory buyers of this stock. It was the easiest way to get exposure to the future of food theme. However, as ESG investing has faced scrutiny and as returns have suffered, many of these funds have trimmed or closed positions. The rotation out of speculative growth and into high-quality cash flow positive tech or industrials has left stocks like BYND in a liquidity vacuum. You can see this in the intraday chart from Friday. The lack of sustained buying pressure, the flatlining after the drops, shows that the buy-the-dip army has largely demobilized. The institutional support levels that usually step in at round numbers like $1 were porous, allowing the price to slip right through. There is also a recent legal development that cannot be ignored. The trademark verdict resulting in a massive damages award against the company, around $39 million, is a catastrophic blow to liquidity. For a company like Apple or Google, $39 million is a rounding error. For a company with Beyond Meat's current market cap and cash burn rate, that is a significant chunk of liquidity that they cannot afford to lose. This legal overhang creates uncertainty, and markets hate uncertainty more than they hate bad news. Bad news can be priced in. Uncertainty makes the asset uninvestable for risk-averse managers. This verdict likely contributed to the recent weakness and the inability of the stock to rally despite broader market optimism in other sectors. So, where do we go from here? What is the future outlook? The bull case relies on a few specific catalysts. First, a successful stabilization of cash burn. If management can cut costs aggressively enough to stop the bleeding, they might buy enough time for the economic cycle to turn. Second, international growth. While the U.S. market has saturated or pulled back, there's still growth in Europe, particularly in countries like Germany and the U.K., where plant-based adoption is culturally stickier. If they can pivot to becoming a lean, export-focused niche player rather than a mass-market U.S. giant, there is a viable business there. Third, the potential for a strategic buyout. At this valuation, the brand recognition is still worth something. A major legacy food conglomerate might look at the decimated market cap and decide to buy the brand for pennies on the dollar to plug into their own distribution network. However, banking on a buyout is speculative and dangerous. The bear case is that the death spiral continues. The stock stays under $1, they execute a reverse split, the short sellers double down on the post-split entity, and the company eventually faces a restructuring or bankruptcy scenario due to the debt load. The reality likely lies somewhere in the messy middle, a long, grinding period of restructuring where the stock remains volatile and speculative.